when you go to an exam, in that exam, the maximum marks are let's say 100. The passing marks are 40. What do you aspire for? Do you aspire to pass, or do you aspire, to do extremely well? Well, some may, like to just pass. In RBI, we like to we like to be on top of everything.
Well, the Reserve Bank governor clearly was on top of his job. While announcing the 0.25% rate cut by the MPC, the governor didn't overpromise on any count. He didn't indicate continued dovishness, nor did he signal a surfeit of liquidity, just appropriate liquidity. So the question is the policy statement too restrained in its dovishness? The GDP forecast for next year, FY26, is at 6.7%, inflation at 4.2%. Is this too ambitious? Both inflation too low and growth a bit too high. The regulations on LCR, that is liquidity coverage ratio, and on expected credit loss, ECL accounting, have been postponed. But the higher risk weights on loans to NBFCs and unsecured borrowers has not been reduced. Is the RBI still too restrictive on credit? Well, to answer all these questions, I have with me an elite panel. Mr. C.S. Shetty, the chairman of the largest bank, the SBI chairman. Mridul, Saggar, former member of the MPC and former ED of the Reserve Bank, now professor at IIM Kozhikode. B. Prasanna, the head of Global Treasury, Global Markets at ICICI Bank, and Samiran Chakraborty, chief economist, Citi, India. Gentlemen, thank you very much indeed for your time. Mr. Shetty, I'm aware that you are in a hurry, so I'll rush the first questions to you. The big point is there is a rate cut, and that will obviously get transferred to loans that are linked to the repo. But when will the first deposit rate cut come for the system, you think, considering that the RBI has also promised appropriate liquidity?
Yeah, thank you, Latha, for having me on your show. It's always a privilege. I think the loans, of course, will repo-linked loans, particularly EBL, are what we call, get repriced immediately. The liquidity measures what RBI has taken definitely improved the system liquidity. And the governor has also promised that he will ensure the durable liquidity. So which means that today, as we speak, while the situation has improved, it is still not in the positive territory. Still the deficit is there. And but a lot of effort on the part of the RBI to ensure sufficient liquidity availability reduces the concerns on the liquidity. Then the deposits, I think it will take a while. Maybe not in the current quarter. I don't think any banks will immediately cut the rates. Even if we, going forward, will cut the rates, there is a significant time lag in terms of repricing the deposits. Yes. Because most of the time, what we have seen in the recent times, people wanted to lock in the rates. So the largest growth of fixed deposits happened in the 1 to 2 year category, which means it takes some time for the deposits to get repriced.
Okay.
But the new deposits...
No, your incremental, yeah. New deposits, when do you think it'll take a quarter to announce a lower rate?
I think this quarter being, Q4 is generally a busy quarter for everyone. Most of the banks would like to push the credit growth also is significant. So obviously at this time, everybody wants to raise the deposits also. Okay. My assessment is that the immediate rate cut on the deposits across the banking system may not happen. Some banks may choose to cut the rates, but not definitely across the banking system.
Okay. What about growth of credit, sir? There were two green signals, I thought, from the governor saying that he's happy with the credit deposit ratio or something to that effect. And on the other side, the counter being that they have not reduced risk weights on anything. So do you think credit growth will start overtaking deposit growth quickly? I mean, it is overtaken in your bank. I mean for the system.
For the system, the narrative from the central bank also seems to be in tune with what government budgetary proposals have been, particularly the credit flow to the MSMEs and agriculture. So I'm sure the governor probably had in mind when he spoke about, the comfortable CD ratio, and even if credit growth happens in these two segments, maybe the central bank will be happy about that, because these are the two sectors which definitely needed to be supported, and from both in terms of job creation and job maintenance. So my view is that the sufficient liquidity will also ensure that the ability of the banks to fund will improve.
Yeah.
So
No, I mean, we are very crucially dependent on this credit growth, because at one point in time, credit growth was actually lower than nominal GDP. Only if credit growth is fueled and goes way above the nominal GDP, like goes to 11-12%, will we start getting economic growth? Can we be confident of growth? That's why I'm trying to pin you down on whether you see credit growth growing and by when.
Credit definitely will grow. I think our overemphasis on unsecured personal loans growth in the system probably overshadowed, the credit flow to other sectors.
Okay.
Now, definitely, with a lot of measures which have been taken in terms of MSME lending, the corporate credit growth will be moderate for some more time. I think we'll have to see how the demand, consumption demand, which is going to be spurred by the budgetary proposals, will it make private capex to pick up, and then they will also start borrowing, is something what we have to be, on the lookout for.
Okay.
But I believe that there is a good growth potential for credit, definitely in the current quarter.
Okay. Well, the hope, of course, for the whole world, I mean, stock market investors as well as corporate sector is looking for growth, and their liquidity and credit offtake are the two things. And both these are something bankers are in a better position to assess. Finally, Mr. Shetty, what about margins? I mean, here you have to talk only from your angle. Does it impact only a little because only repo-linked loans get priced lower, and you're saying it will take at least a quarter for the first cost of your raw material to fall, deposits. So margins will be under pressure for a couple of quarters for banks?
In our portfolio, of course, we have limited EBLR linked portfolio is about 29%. So the impact of this rate cut of 25 basis point will not have major movement in the NIMs. Even if on an annualized basis also, I don't think if the rate cuts become more frequent and deeper, then we'll have to see. Obviously, the deposits also will get, some transmission will happen on the deposit rates also. But this rate cut is not going to significantly impact SBI in particular, even in the banking system in general.
Okay. Finally, sir, before I let you go, any other takeaways that you found from the policy?
I saw a lot of takeaway from your shows from the morning, Latha. Definitely, I think the intent of the central bank seems to be, growth oriented, and there are a lot of nuances in the governor's speech and the press interaction. And one of the overhangs in terms of the policy in regard to LCR being removed, I think definitely it's a positive for the banking industry.
Oh, yes. I expected that bankers are extremely thrilled with not having to lock up liquidity, at least for the next 1 year. Mr. Shetty, pleasure having you with us. Thank you very much for making time for us. And I'm glad your flight landed on time and we could have you on the show. Thank you for joining us, sir.
Thanks.
Okay, let's now parse the policy in terms of economic and market impact. And we have our experts with us. Prasanna, to start with you, the yield went up actually by 1 basis point, the 10-year yield. You have got a rate cut and you go up from, I think at one point it was even 6.65 and then went up to 6.7 by the time it ended. Why? What did the market take away?
So I think, Latha, there are two or three things. One is the fact that the market had already kind of expected the repo rate cut. And there were sections of the market which was also expecting a change in stance, which didn't come through. And there were also people who were expecting further liquidity measures as a follow-up of what they had already announced in the previous 15, 20 days. So some of them didn't come. The change in stance and further liquidity measures didn't come. And that was two reasons why market took it negatively. But more importantly, I would say that the fact that what is really actually good for the real economy could have been bad for bond markets today. And I'm referring to the LCR norms, because there was some level of expectations that if the new LCR guideline were impacted, it would have been positive for the bond market because of the incremental 4 to 5 lakh crores of demand in the next year coming in from for HQLA assets coming in from the banking system. So if you remember, when the draft guideline came in, there was around 4 to 5 basis points of rally when that happened. So I guess some of it is just payback of that and giveaway of what rally which actually took place at that time. But the yields going up today, I would presume, has nothing to do with the stance of the policy, what the governor has spoken, what the policy has done. I think it's a great policy. And I think there are a lot of nuances which we can possibly discuss over the next 15, 20 minutes. But I think there are some positives for the bond markets as well. And they will come to, react to this over the period of time. Of course, always the global uncertainties remain, and we have to always, take that into account.
Keep that in mind. Absolutely, absolutely. Samiran, would you say the RBI is being a little too ambitious at 6.7%? We are heading into a very difficult geopolitical situation.
So, Latha, our sense is that we have to think about growth from a more holistic perspective. First, to start with, the December quarter GDP growth is already probably up to about 6% odd. So the path to traverse from here to that 6.7 is not too far. And we have had at least three different things going in our favor. One is that at central government level, the public capex for FY25 itself has got accelerated quite significantly. The expectation is that for the Jan-March quarter, it would be 21% year over year if the revised estimate targets have to be met. Second is obviously the income tax cut announcement in the budget, which can spur consumption activity in the short term. And third is the overall package that the RBI has put in today with rate cut as well as promise for better liquidity and a more pragmatic approach towards macroprudential measures. So this whole policy nudge, both from the fiscal and monetary policy side, we think is good enough to push us up to that sort of a number. Our own forecast was even before the policy at 6.6, which is not too different from the RBI's forecast. So that way, I'm quite comfortable that we are on the right track on growth.
Okay. Well, I heard a large number of economists who are at 6.5 at best or south of it. But yes, you told me 6.6, and I think ICICI PD has 6.8. So there are some people who are willing to, bet on a better growth. Mridul, Saggar, I wanted to ask you, what do you make of the governor's statements on liquidity? I personally asked him that the rate cuts will not get passed on unless you keep surplus liquidity. So what did you make? Will they keep it surplus, or was he shy of promising and stopped at appropriate and not ample liquidity?
Latha, we have to recognize that market expectations were running ahead of what was feasible and what was desirable in this policy. And I think the governor rightly chose to temper that expectations, because it's very important to calibrate things and not commit too much forward, especially when you have high uncertainty. So from that angle, I think we have to read his liquidity statement with some nuances, in the sense that it's not that he's saying I will flush the market as the market expects. Neither is saying I would commit the same mistake what had happened over the previous quarter of very tight liquidity, which came on the back of forex interventions and stuff. So you have to see that the reserve money growth this year has been very dismal. At 3.5% year on year, I think this is something which one reminds of the Great Depression mistake of the Fed, where basically the monetary policy was kept too tight to defend the dollar. So as we go forward, they can use FX buy-sell swaps. They can do open market outright sales.
That's exactly why I'm asking, Mridul, why not promise surplus liquidity? Why only stop at appropriate?
So appropriate doesn't mean that you are in deficit necessarily. So appropriate is that you're not flushing the market as you're actually doing so in times of, say, extraordinary crisis like the global financial crisis or the pandemic. So he has said he will be proactive and he will look into it.
Okay, so you think...
I say open market bond purchases he'll make, and then he will obviously add to the liquidity as it may be required. We have to be cautious. See, if you have a more 2 trillion coming in form of RBI profit transfer surplus and the government spending pickups, you can make mistakes on the other side.
Okay. So especially when the rupee is, especially when, speculators may use the cheap money to short the rupee. Fair point. So the governor's appropriateness is better than being ample in his liquidity promise. We have to take a quick break, but lots of questions on, the new instruments that he has given on, what are you expecting in terms of the next rate cuts? All that coming in a jiffy after this break. Welcome back. We've been discussing the monetary policy that was announced by the Reserve Bank, which cut the repo rate by 25 basis, but didn't quite indicate whether there will be more rate cuts, because it said that we will look at every policy afresh with the new macroeconomic indicators, and that this less restrictive policy is for this one. That was a very clear statement the governor made. Speaking to me for the past 15 minutes in this show are Mridul, Saggar, former MPC member, B. Prasanna, who heads the global markets at ICICI Bank, and Samiran Chakraborty, the chief economist at Citi India. Gentlemen, thank you for your patience. Prasanna, you said there are a lot of positives. What did you take away?
So I think, Latha, the first thing is the fact that he did speak about the efficiency versus the stability trade-off. And he did at length speak about the cost of regulation and the fact that you can, he didn't say that, but that sometimes over-regulation can also lead to loss of efficiency, which is what is the inbuilt message in it. So I guess that's the first thing that I can think about, because a tightening regulation can also lead to a lower credit growth.
Okay.
And the second is the fact that I think there was a little bit extra emphasis on the flexible part of the inflation targeting. And while I think he did mention that it is more for this policy and it is more used as a justification for the current rate cut, I think reading between the lines or hearing between the lines in this case, I would assume that going forward as well, we have a little bit more bias towards growth than towards inflation in the past. So I think, and also the fact that we are now doing policy on expected inflation, and as long as we are comfortable with the inflation trajectory going towards 4, we don't need current inflation to be at or above lower than 4 for us to cut rates. Maybe all of these would have also happened in the earlier regime as well, because it is just now that the circumstances are becoming a little bit more positive. So I think these were the main positive from my side. And of course, the thing about liquidity that you spoke with and Mridul spoke about, it gives us a lot of confidence that even the fact that they have really been aggressive in their actions in the past means that while they could have done more this time, but I think they will react a little bit faster and more aggressively as and when liquidity needs comes up for the banking system as we go forward.
Okay. All right, fair enough. That's the comfort as far as a banker and a bond expert is concerned. Samiran, how many rate cuts are you expecting? How would you draw the macroeconomic indicators looking forward?
So obviously there are lots of uncertainties both globally and domestically. So what we can at best do is go on the basis of the forecasts that have been put in place. So if we trust the FY26 GDP growth forecast of 6.7% and the CPI forecast of 4.2%, then on that basis, one can say that another 50 basis point rate cut from here would probably take us to the kind of neutral rate that RBI has been comfortable with in the past on the basis of expected inflation. And if RBI at some point of time reconsiders that neutral rate range of 140 to 190 basis points and brings it lower, as some of the earlier MPC members have suggested, then you could see scope for more rate cuts beyond that 50 basis point also. On the growth side, it looks like even if we meet that 6.7, that's lower than the potential growth that RBI would be considering. So from that perspective, there is no real urgency to stop on rate cuts because of growth overshooting expectations. It will all boil down to what extent we are closer to that 4.2 forecast on CPI for FY26.
Okay. Thanks for that. That's well argued. So at the moment, let's only look in for 50 basis. Let's see how things pan out. Mridul, would you say that for a maiden policy and coming after such a lot of criticism that the Reserve Bank faced for tight liquidity, it's well delivered, not bending too much in terms of dovishness, and yet, giving reasonable amount as, if a person like Prasanna can be happy, must have delivered something.
No, absolutely. The script of the MPC resolution was very good, very well balanced. Even governor's statement was reasonably well balanced, though a couple of things were there which were a bit sort of different from one would have expected.
Such as?
So clearly he's sort of hinting at use of more flexibility, but he's also trying to reinstate the inflation target. I hope that target means it is 4% because that's the law.
No. Actually, Mridul, he was very clear that he will chase that target. In fact,
yes.
After the press conference, I specifically asked him why did he bring up the flexible inflation targeting as the first paragraph in the statement,
Okay.
and he said to commend the framework, not to use that extra flexibility,
and he
but to
started
indicate
conference
support.
On that basis. So I fully recognize that he was having faith in inflation targeting, and he said that. My only downside was the press conference probably hinting a bit too much about regulation relaxations and postponement, which could have waited probably a more in-depth analysis of what are the risks and what needs to be done. Because on the LCR, you have to acknowledge that the world is changing. So it's not just the internet deposits. We'll soon have programmable deposits.
Yeah.
And do we need to tighten the LCR rules for that? If we have to, we have to. But facing them is fine, but one shouldn't really give up these regulations.
I'll tell you two things on that. The previous RBI regime, that is those who were already with who are proponents of the LCR regime, told me that they would have postponed it. Because of the difficult times we are in, tight liquidity and rupee under pressure. So it would have come anyway. And to be fair, while he said that there is a cost, he also said, I'm sure the Reserve Bank takes into account the cost. So, there was a comeback statement as well. Unfortunately, out of time. Prasanna, I'm giving you only 10 seconds here. But tell me, this saying banks have to lend in the call market. Why are you not lending, egging them to lend? As well, this new derivative instruments, allowing brokers registered with SEBI to come in. Do you think the debt market is now in for a good time because of all this?
So we already had a product called Bond FRA, which was active. Now I think the Bond Forward will become attractive as well for companies like LIC and other insurance companies. So it's a very good development that can lead to more demand for longer term bonds and help these insurance companies to reduce their reinvestment risk. And as far as the first question is concerned, Latha, I think that the governor is basically edging banks to actually look at the arbitrage even on an intraday basis. There have been times when the rates are very high in the morning and low in the second half, and it's quite possible for banks to, lend in the morning and kind of borrow in the evening. And some of the banks, we just don't do these kind of, if you're either a borrower, we just stick to borrowing. If you're lending, we just stick to lending.
He wants you to do
both. Nudge. He wants us to do both, but I would say that that nudge should come actually on the collateralized market as well, not just the uncollateralized, which the governor spoke about. Maybe that was not intended to be only for that market, but we will see as well.
But there is going to be a committee which is looking at the timings of all the markets. So maybe that they've promised a committee which will look at the chrome market, the collateralized repo market, their timings, he said, but maybe it will look at other things as well that you are pointing out. All told, actually, it's a many splendored policy, though it looked like a brief statement. Gentlemen, out of time, but I think most of you are giving a thumbs up to the policy. On that note, wrap up on this special show. Let's leave you with the first government reaction we got to the Reserve Bank policy. Finance Secretary Tuhin Kantapande.
I think it's a very positive step, and it is taking the whole thing forward, pro-growth, and I think this is a very good step.
Right. The statement also appears to place growth over inflation. Is this something that the government would be more or less in sync with, given the current scenario?
I think it is not this or that. It's not growth versus inflation debate. I think keeping in view the inflation, as well as the growth imperative, MPC has taken the right call.